Former Stanford University students Evan Spiegel, Bobby Murphy, and Reggie Brown founded Snapchat. It is well known for taking social media in a new mobile-first direction and emphasizing user engagement with augmented reality objects and virtual stickers. Recently, Snapchat has undergone significant change. The app no longer appears or functions as it did in the past due to frequent updates. Luckily for you, Fortune Fastlaner, for today's video, we will be talking about Snapchat. Did you know that their stock tank melts? And then their founders set up a stock split. Remember that while the first step is completing any of this amazing information, the second and possibly more important step is taking action, even if it's an imperfect action. Even if you're a regular user, Snap, the company that created Snapchat, is so aggressive about making changes to the app that it can be challenging to keep up with how Snapchat actually operates. What is Snapchat? For both iOS and Android devices, there is an app called Snapchat. Users of the app frequently refer to it as Snap in informal settings. Confusingly, a publicly traded company also called Snap serves as Snapchat's developer. The business describes itself as a camera company. Whatever name you give it, Evan Spiegel, a co-founder, is in charge of Snap. One of the fundamental ideas behind the mobile app is that any image, video, or message you send, known as a snap, is by default only made accessible to the recipient for a brief period of time before it disappears. The app's transient or ephemeral nature was initially intended to promote a more organic flow of interaction. What does Snapchat serve? Although Snapchat's original focus was on private, person-to-person photo sharing, you can now use it for a variety of purposes, such as sending videos, live video chatting, messaging, creating Bitmoji-like caricature avatars, and sharing a chronological story that is broadcast to all of your followers. There is even a special discovery section that highlights condensed content from well-known publishers like BuzzFeed. Snapchat even enables private media storage. You can also show your current location on a map of the entire world and add filters and AR-based lenses to your snaps, among other features. But the most important thing to understand about Snapchat is that it revolves around instant messaging on your phone. Social media was primarily desk-based before Snapchat. For instance, you could post status updates, tweets, and photos online and keep a record of all of them, so that you could all view them in the future and receive comments from your friends. Snapchat revolutionized online communication. With Snapchat, you can quickly send a friend a picture of you wearing an outrageous AR lens, and as soon as they open it, it vanishes forever. Technically, they have the option to screenshot the message and respond with a photo or video that they can also broadcast to their story for the benefit of their friends and followers. This app has so many applications, it's difficult to deny its worth and the reason it's special. It seems strange to focus on a novel stock split plan that would enable Snap CEO and its head of technology to cash out while maintaining dominant control of the business as it goes through a difficult time. Since its founding, Snap Inc. has never been an investor-friendly company. And last Thursday, the parent company of the Snapchat app made the point even more emphatically. In response to a significant slowdown in its digital advertising business, Snap's Snap 1.47% board came up with a novel dividend designed to ensure that the company's founders retain control of the business, even if they choose to sell their stock. The dividend will only be paid if shares reach $40 within the next 10 years. It will take the form of a 2-for-1 stock split, giving each investor a new Class A share for each share they currently own. Full coverage of earnings? Snap stock falls 25% as advertising slows. Executives refuse to provide forecasts. If you consider that Snap was trading for $40 per share as recently as January, that would seem like a simple target to hit. But since late last year, Snap attributed a significant decline in its advertising revenue to changes in Apple Inc. AAPL, negative 0.26%, had made the iPhone's ad tracking and advertisers hurt by supply chain issues, and Snap stock has come under intense pressure. Snap stock has decreased by about 78%, since the October warning when it was trading near $75. In after-hours trading on Thursday, the stock was once again falling precipitously to around $12, following yet another dismal earnings report in which Snap's founders couldn't muster the courage to even provide a financial forecast. Since the beginning, Snap has been designed to please its two founders, CEO Evan Spiegel and CTO Bobby Murphy. When it went public in 2017, it only offered Class A shares with no voting rights. This was unprecedented at that time and hasn't been repeated in a major IPO since. Spiegel received a CEO bonus of 3% of the company, even though he already owned a sizable portion of it. As a result, Spiegel and Murphy hold a whopping 99.5% of the company's voting stock. Following Snap's disappointing second quarter earnings report released after the bell on Thursday, shares of social media companies were falling on Friday. Snap revealed its hand by blatantly stating in a letter on Thursday that the move was specifically for their founders' benefit. Other businesses that have recently announced stock split plans, such as Telsa Inc., TSLA, 1.66%, and Amazon.com Inc., AMZN, negative 0.47%, have claimed that their actions were intended to help their employees manage their stock compensation. With the opportunity to receive one Class A share for each super voting share they currently own, the founders can continue to give or sell stock without losing their ownership or voting control. Although the two executives have recently been heavily involved in philanthropy, the action seems self-serving. Are the co-founders merely ensuring that they can donate more easily, or are they tinkering away as Snap burns? On the company's conference call last Thursday, no analyst asked a question about the dividend plan, which is probably because it is obvious that Snap won't see a $40 stock price anytime soon. Investors should focus more on Snap's declining advertising business than on whether it is a sign of the economy or something more fundamentally wrong with Snap. Investors received a strong reminder last Thursday if they had doubts about how founder-focused Snap is. Investors have no say in the matter, regardless of whether those founders are worth it or not. As of 10:36 a.m. ET, Snap stock was down 36%, trading at $10.41, dragging shares of Meta and Pinterest down with it, as investors worry about a general slowdown in online advertising sales. The parent company of Facebook was down almost 6% to $172.28, while Pinterest was down about 12% at $18.43. Another leading indicator of an online ad revenue, Google parent Alphabet, saw a 3% decline. Snap's disappointing second quarter earnings, where it reported $1.11 billion in revenue versus expectations of $1.14 billion, have the social media industry reeling. The company reported that hiring would be slowed and it would not provide guidance for the upcoming quarter. Earnings per share decreased by 2 cents, compared to expectations of a loss of 1 cent. After Friday's sharp decline, the stock lost over 75% of its value in 2022. In an investor letter, Snap acknowledged its dissatisfaction with its financial performance, stating that, "We are not satisfied with the results we are delivering, regardless of the current headwinds." The company cited both low advertiser demand and inflationary pressures. The business also said it would keep reducing operational costs and its hiring budget, but it would not provide third-quarter earnings guidance because forward-looking visibility remains incredibly challenging. Due to low advertising spending due to economic slowdown predictions, social media has been particularly hard hit among tech shares. Investors were shocked by Meta's first-quarter earnings, and the sell-off that followed in early February resulted in the single largest loss of market capitalization in the history of stock market. Following the publication of the social media company's second quarter earnings report last Thursday, July 21, Snap stock fell 27% in after-hours trading. Its revenue increased 13% year-over-year to $1.11 billion, falling out about $20 million short of analysis predictions. With difficult macroeconomic challenges, Snap had already warned investors in May that its second quarter revenue would come in below the low end of its prior guidance of 20% to 25% growth. Snap's adjusted EBITDA fell 94% to just $7 million, while its net loss increased from $152 million to $422 million. Nevertheless, its non-GAAP loss of 2 cents per share still outperformed Wall Street expectations by 1 penny. While Snap's average revenue per user decreased 4%, its daily active users still increased 18% year-over-year to 347 million. Those results are terrible, but 6 more warning signs show it's still too early to think that the battered social media stock as a turnaround play. Number 1. No more direction. In the third quarter, Snap chose not to provide guidance for its quarterly revenue and adjusted EBITDA due to uncertainties related to operating environment. Particularly, Snap continues to struggle with Apple's iOS privacy changes, the war in Ukraine, and COVID-19 related market disruptions. Worldwide restrictions on digital ad purchases due to inflation and rising interest rates have made this pain worse. Although Snap's cautious outlook is not unexpected, the company previously told investors during its Investor Day presentation in February that it could achieve 50% plus revenue growth for multiple years. Number 2. Refusing to give up on the 50% goal. When it came to the 50% target, Snap was questioned on a conference call. Instead of responding to the query, CFO Derek Anderson stated that despite near-term macro headwinds, Snap could still be well-positioned over time, as it launched new features and increased its international presence. Analysts predict that Snap's revenue will increase by about 22% to $5.03 billion for the entire year and another 32% to $6.63 billion in 2023. But these projections will probably be lowered following its most recent earnings report. Instead of obstinately upholding it and undermining investors' faith in its long-term plans, it would be more responsible to simply walk back to its 50% goal. Number 3. Stopping its hiring expansion. Anderson added during the call that Snap would effectively pause hiring. This choice might assist it in controlling costs and expenses, which increased by 29% year-over-year to $1.51 billion during the quarter, and stock-based compensation costs, which ate up 29% of its overall revenue. Spending less might make it harder for Snap to introduce new features and complete its tenacious rivals like ByteDance TikTok and Meta Platforms Instagram. Number 4. Diminished cash flows. In the second quarter, Snap produced a negative free cash flow of $147 million as opposed to a negative FCF of $116 million a year earlier. Snap still has $4.9 billion in cash, cash equivalents, restricted cash, and marketable securities on hand at the end of the quarter, so it won't run out of money anytime soon. However, it continues to lose money, and its high debt-to-equity ratio of 1.6 limits its ability to raise additional capital. Number 5. A buyback of $500 million. When an unprofitable company with a negative FCF approves a sizable buyback, it raises a huge red flag. That's exactly what Snap did when it unexpectedly decided to buy back $500 million worth of its Class A shares. A portion of the dilution caused by the issuance of restricted stock units to employees will be offset, according to Snap, by the buyback, which will last for the following 12 months. This buyback, therefore, represents weakness rather than strength, and it won't actually result in lower share prices for the company. Number 6. An ineffective stock split strategy. Last but not least, Snap promised to split its stocks into one Class A share for every share that was then outstanding if it reached $40 within the next 10 years. This decision, which primarily intended to allow the company's founders to sell more Class A shares rather than their exclusive Class E shares, which each carry 10 votes, is pointless and appears to be an ineffective attempt to join the stock split trend. These problems together imply that Snap is in deep trouble. Investors seeking a more durable social media play should give Meta another look. It may have a better chance of making a long-term comeback. After the company hinted that headwinds worsened in the past, Snap stock fell by more than 40%. Shares of Snap plunged after the company informed shareholders that the current quarter was going less well than anticipated. The stock has now lost 80% of its value from its peak. It's not surprising that people are interested in purchasing Snap. A sharp decline in valuation frequently draws value-conscious investors. Let's take a closer look at its potential and determine whether long-term investors ought to start purchasing Snap shares. The demand for advertising is declining due to macroeconomic factors. Snap is a social media platform that you can use and join for free. The number of daily active users has increased to 332 million from 319 million in the previous quarter. Snap earns money by displaying advertisements to users while they are using the app and website for free. It did a fantastic job in that regard. From 2016 to 2021, the company's revenue increased from $404 million to $4.1 billion. Marketers' desire for the chance to influence Snap's hundreds of millions of daily users is the cause of the tenfold increase. Snap is also gaining from the advantages of digital advertising over non-digital advertising. If you see a compelling advertisement, users browsing Snap on their phones, computers, and tablets are just a few clicks away from making a purchase. Contrast that with media like radio, newspapers, billboards, and even cable TV, where customers are even further away from the point of purchase. The majority of advertising is done by businesses because they want you to buy something. Of course, some advertisers exist only to raise brand awareness and not compel a purchase. Global marketing spending increased by 22.5% in 2021 to $763 billion. It's interesting to note that the proportion of money spent on digital channels increased from 52.1% in 2019 and 64.4% in 2021. The 2022 advertising budget may be stagnated or be reduced due to economic headwinds. Supply chain shortages for everything from baby formula to cars to video game consoles are being brought on by the coronavirus pandemic. When it comes to new and used cars, dealers demand and successfully convince customers to pay thousands more than the recommended manufacturer's retail prices. When there is such an imbalance between supply and demand, advertising is less necessary. These are the challenges Snap mentioned when it informed investors on May 23 that it would not achieve the second quarter guidance it provided in April 21. The stock dropped more than 40% the day after the announcement as a result of the update. After crashing, is Snap stock still affordable? The quick response is no. Snap stock is not inexpensive, even after the crash. Snap is the most expensive among its rivals Pinterest and Meta platforms, with a price-to-sales ratio of 5. Snap is more expensive than its next closest competitor when measured by the price-to-free cash flow ratio. Due to a potential buyout from Elon Musk, it should be noted that Twitter was not included in the discussion. In order to answer the question in the headline, value investors should hold off on purchasing Snap stock for the time being. Despite having significantly decreased in price, it remains expensive. That's it for this video, Fortune Fastlaner. Remember to subscribe to our channel. And if you feel like we've delivered value, please share this video with one person. That's right, just one person, as a token of your appreciation for the hard work we put into making content that educates and helps you on your mission of building your own fortune. Remember, you can watch video after video, but it isn't until you actually take action that you'll start to see results. See you on the next one.